Subscribe to this channel for more videos so that you don't miss any update. And don't fail to hit the like and share buttons so that your friends can see it.
A rectangle is a chart pattern, formed when the price is bounded by parallel support and resistance levels. A rectangle exhibits a period of consolidation, or indecision between buyers and sellers, as they take turns throwing punches, but neither has dominated. The price will test the support and resistance levels several times, before eventually breaking out. From there, the price could trend in the direction of the breakout, whether it is to the upside or downside. In the chart, we can clearly see that the pair was bounded by two key price levels, which are parallel to one another. A bearish rectangle is formed when the price consolidates for a while during a downtrend. This happens because sellers probably need to pause and catch their breath before taking the price any lower. Always remember that rectangle is a continuation chart pattern. Put your sell stop order here, 5 pips below the support level. Stop loss should be here, 10 pips above the support level. The profit target should be the size of the rectangle. In the chart, price broke the support of the rectangle chart pattern, and continued to go down. Once the price falls below the support level, it tends to make a move that is about the size of the rectangle pattern. Though the price can go further than that. Here's another example of a rectangle, this time, a bullish rectangle chart pattern. After an uptrend, the price paused to consolidate for a bit. Can you guess where the price is headed next? Remember we said that rectangle chart pattern is a continuation pattern. Set your target based on the range of the rectangle.
You can see how the price moved all the way up after breaking above the top of the rectangle pattern. Just like in the bearish rectangle pattern example, once the pair breaks, it will usually make a move that's at least the size of its previous range.
Similar to rectangles, pennants are continuation chart patterns formed after strong moves. After a big upward or downward move, buyers or sellers usually pause to catch their breath before taking the pair further in the same direction. Because of this, the price usually consolidates and forms a tiny symmetrical triangle, which is called a pennant. A bearish pennant is formed during a steep, almost vertical, downtrend. After that sharp drop in price, some sellers close their positions while other sellers decide to join the trend, making the price consolidate for a bit.
As soon as enough sellers jump in, the price breaks below the bottom of the pennant and continues to move down. As you can see, the drop resumed after the price made a breakout to the bottom. To trade this chart pattern, we'd put a short order at the bottom of the pennant, with a stop loss above the pennant.
That way, we'd be out of the trade right away in case the breakdown was a fakeout. Unlike the other chart patterns wherein the size of the next move is approximately the height of the formation, pennants signal much stronger moves. Usually, the height of the earlier move, also known as the mast, is used to estimate the size of the breakout move.
In this chart, we are looking at bullish pennant chart pattern. The price made a sharp vertical climb before making a pause. It is handled just like the bearish pennant chart pattern but in the opposite direction. Remember, pennant chart pattern are known as continuation chart pattern. We'd place our long order above the pennant, and our stop below the bottom of the pennant, to avoid fakeouts.
Like we discussed earlier, the size of the breakout move is approximately the height of the mast, or the size of the earlier move. Pennants may be small in size, but they could signal huge price moves, so don't underestimate them.
A triangle chart pattern involves price moving into a tighter and tighter range as time goes by, and provides a visual display of a battle between bulls and bears. The triangle pattern is generally categorized as a continuation pattern, meaning that after the pattern completes, it's assumed that the price will continue in the trend direction it was moving before the pattern appeared.
A triangle pattern is generally considered to be forming when it includes at least 5 touches of support and resistance. For example, 3 touches of the support line, and 2 for the resistance line. Or vice versa. There are 3 types of triangle chart formations, namely, symmetrical triangle, ascending triangle, and descending triangle. A symmetrical triangle is a chart formation, where the slope of the high prices and the slope of the low prices converge together to a point where it looks like a triangle. What's happening during this formation is that the market is making lower highs and higher lows.
This means that neither the buyers nor the sellers are pushing the price far enough to make a clear trend. If this were a battle between the buyers and sellers, then this would be a draw.
In the chart, we can see that neither the buyers nor the sellers could push the price in their direction. As these two slopes get closer to each other, it means that a breakout is getting near. We don't know what direction the breakout will be, but we do know that the market will most likely break out. Eventually, one side of the market will give in. In a symmetrical triangle, we know that the market can go either way, either up or down.
How do we trade symmetrical triangle? We can place entry orders above the slope of the lower highs, and below the slope of the higher lows, of the symmetrical triangle. Since we already know that the price is going to break out, we will go whatever direction the market moves.
Do not forget to place your stop loss to avoid fakeout. Remember to place your target based on the size of the triangle.
An ascending triangle is a type of triangle chart pattern that occurs when there is a resistance level and a slope of higher lows. What happens during this time is that there is a certain level that the buyers cannot seem to exceed.
However, they are gradually starting to push the price up, as evidenced by the higher lows. They keep putting pressure on that resistance level, and as a result, a breakout is bound to happen.
Now the question is, which direction will it go? Will the buyers be able to break that level, or will the resistance be too strong?
Many charting books will tell you that in most cases, the buyers will win this battle, and the price will break out past the resistance.
However, it has been our experience that this is not always the case. Sometimes the resistance level is too strong, and there is simply not enough buying power to push it through.
Most of the time, the price will, in fact, go up. The point we are trying to make is that you should not be obsessed with which direction the price goes, but you should be ready for movement in either direction.
In this case, the buyers lost the battle, and the price moved downward. You can see that the drop was approximately the same distance as the height of the triangle. As you can see, descending triangles are the exact opposite of ascending triangles. In descending triangle chart patterns, there is a string of lower highs that forms the upper line. The lower line is a support level.
Now most of the time, the price will eventually break the support line and continue to fall. However, in some cases, the support line will be too strong, and the price will bounce off of it, and make a strong move up.
The good news is that we don't care where the price goes. We do know that it is about to go somewhere. In this case, we would place entry orders above the upper line, and another below the support line.
In this case, the price ended up breaking above the top of the triangle pattern. After the upside breakout, it proceeded to surge higher, by around the same vertical distance as the height of the triangle.
Subscribe to this channel for more videos so that you don't miss any update. And don't fail to hit the like and share buttons so that your friends can see it.
Please drop your comment below.
Thanks for watching.